Okay guys, happy 4th of July. I wanted to make a quick video for you guys this morning. The goal is to keep it to about 10 or so minutes about asymmetric risk. A lot of you guys are stuck with P&Ls that are kind of flat, okay? You feel like you're close to being profitable, but you take 3 steps forward and then 4 steps back, 2 steps forward, 1 step back. I want to try and fix that for you today by having you implement using asymmetric risk based on the type of opportunity that's in front of you when you're trading. Okay, so I made this chart and I posted it up a couple days ago without the colors. And so very briefly, what this chart is showing you is if you are, it's using some statistics. If you're looking for a 70% chance of making $3,000 before you lose $2,000, that trails a high watermark, similar to most prop evaluations. This helps us visualize what it looks like per RR per win rate combination to have that same 70% chance, right? So everything on this chart is static in the sense that if there's a 50% chance of me making 2.25R, then I'm gonna have to risk $256. And that's the equivalent opportunity to if I have a 3R trade in front of me with a 50% chance, I can risk 425 and 20 cents. The efficiency of my capital is identical with those two scenarios. So keeping that in mind, let me kind of slow down and break this down for you guys. When you are evaluating your trade opportunity and you're thinking, okay, I want to take a long, and you're looking at the chance of you having a successful trade, and you're looking at how far this trade can potentially go, that by itself should dictate how much you want to risk on the trade. A lot of us sit back sometimes and think, okay, look, I'm going to risk 500 per trade. I'm going to risk 250 per trade. I'm going to risk 100 per trade. I'm going to risk 1%. Whatever the static amount is that you have in mind for your risk management. And I want to let you know that by doing that, if you continue to take C trades, B trades, A trades, and A plus trades, those C and B trades are going to water down your P&L from the few A plus trades that you're able to capture over the course of a week or over the course of a month. What I want to propose to you is, instead of necessarily cutting out C trades, I want you to think of your trade opportunities based on how much that they can return you over a span of trades based on probabilities. So we're going to look at this chart. We can see that if I'm looking at just a standard 2R trade, and I'm going from 45% up to greater than 75% chance of succeeding, an $81 bet size with a 45% chance on a 2R trade is the equivalent over time of having a 70% pass rate on this type of scenario up here as taking a 65% trade at that same 2R target, but you have higher probability because the setup's a little bit better, and you risk $872. Now, for a lot of you who understand what I'm saying, this can be a game changer because a lot of you think if I risk more money per trade, then I'm risking more risk in the sense that I'm going to blow up my account faster. And what I'm trying to propose to you is if you risk more money per trade on the A plus setups that either have a higher win rate or a higher RR potential, or both ideally, then you are going to have more efficiency with the capital that you put in play, so that over time you are going to have a much better P&L curve that slopes upward in sort of that exponential pattern versus risking a standard $195, $200 per trade, even on your A plus setups and even on your C or your D setups. If you risk a static amount on a D setup, then you're over betting and you're really destroying your potential P&L curve. And then if you risk a static amount that under bets your A plus plus setups, the ones that come around once a week, the ones that come around, 2 times, 1 time a week, maybe even just 1 time every 2 weeks. If you don't put enough size behind those A plus plus opportunities, then your entire P&L will be watered down by all the trades you took that you over bet on that were C trades. You don't notice this unless you look at the actual stats, unless you look at the actual numbers on the on this table. And now keep in mind, guys, this is for a 70% chance. Obviously, based on math, if you wanted to have a 90% chance of passing, then these numbers would all come down a little bit. If you wanted to have a 50% chance of passing, they would all go up. We don't care about the percent chance, and we don't care about the $3,000 or $2,000, because you could be trading a personal account, you could be trading a larger size account that needs more profit target, less drawdown. These individual numbers are not the focus of the video. The focus of the video is to illustrate that for the same RR target, the better the trade probability, the more you need to be risking in order to use your capital efficiently. The greater the potential distance of the trade, the more you need to be risking in order to efficiently use your capital. So how do we decide what is a good trade, right? Nobody knows the future. So the biggest argument people have for using asymmetric risk is, well, you know what, Alan, I don't know how far the trade's going to go. I don't know if it's going to be successful. A static risk is the best way to succeed, et cetera, et cetera. And if you don't know your system, if you don't have as much experience, that, I believe, honestly, is a valid argument, okay? If you have been trading, if you have back tested and forward tested, you have some type of playbook where you've got your system in place, you know what good trades look like, and you know what bad trades look like in a very general sense, then you can find the native RR, the native win rate for trades. What I don't want you to do is look at a trade and say, my target is at the liquidity high. Oh, but if I extend it out just, a little bit further, I can make it a 4R trade and then I can risk more. That's not how it works, okay? You take the target that the chart gives you and you assign a probability to it based on your experience with the potential speed bumps that are en route to that target. For example, if we have, let's see here, do this quick. If we are coming down and we've got a kind of set up like this, right? Let's just say price is coiling down, and I would consider this a low resistance liquidity run to the upside, okay? We hit a major level somewhere down here, and then I'm looking to gauge a trade back up, okay? It is much more likely that the trade is going to smash this entire range. As any trader knows, it's much more likely that this is going to play out up to this high versus if you have a trade where maybe you have something similar to a bearish breaker in the way, and then it comes lower, and now you come back down to that same area. It's much more likely that when you get to this area here, the trade will do a deep pullback and then maybe continue up and go higher, okay? Because of what we are looking at in terms of a speed bump along the way. So when we are thinking about our trades, what I want you to think about is, how far can this trade go? Can this trade go 3R smoothly, efficiently with, X amount of probability, or can this trade only go 2R smoothly and efficiently before it hits some speed bump that's maybe a UFVG right up here, like an older breakaway gap, or it hits a bearish breaker right here, something that'll make the trade want to retrace deep, okay? So when you're thinking about this, I want you to sit back and say, what is the range that I expect on this trade? And here is how you want to think about how much size to put behind it. Let's say you have a 3R trade that's smooth, okay? And it has that low resistance liquidity run going up. And you're like, wow, okay. Based on my past experience, I have a 55% chance of hitting this 3R trade. You could bet $711 in this scenario on that trade. But then if you sit back at that same chart, that same pattern, and you go up and you say, okay, now in this setup, there's a breaker sitting there that prevents an easy 3R target from hitting. It might only go 2.25 before it hits that breaker and wants to retrace in most scenarios. Then you can say, okay, look, instead of the trade, 55% going up to a 3R, I think there's a 55% chance it's going to go up to a 2.25. You risk less. You don't risk the same amount. You risk 450 in that scenario, and that is the same capital efficiency as the 711. So to bring this whole thing home and to keep the video short, I want you guys to think about, is the structure of my trade the base What level did I come into? Did I come into the 200 daily moving average? Did I come into a strong daily fair value gap? Did I come into VWAP? Did I come into the New York midnight opening price? Did I come into 6 p.m.? Did I come into a combination of those prices as the base where I expect the turn? The more you come into a strong foundation in terms of, okay, look, I see a lot of confluences here in this area, right? Maybe I have 2 or 3 or 4 different things overlapping. That increases your odds of the price wanting to turn and run another direction, okay? That's what I call the base, the support. You want to grade those based on your system. And then you want to grade how far can this run natively without me extending the TP, without me hitting some arbitrary liquidity high. How far can this run in most scenarios before I get a deep pullback? You don't always need to go for the liquidity high. You can go for that premium internal liquidity. You can go for that premium breaker. You can go for that premium order block if you're thinking about ICT terms, okay? So then once you have a grade on your base, what level did I come into? How much confluence do I have? What time of day? Should price turn here? If it does turn, will it turn with conviction? Once you grade that, then I want you to grade, you can just grade it A, B, C, or D. You don't have to do percentages, just A, B, C, D for the turn. Then I want you to grade the distance. Is the distance 1R until I hit resistance? Is the distance 2R? Is it 3R? Is it 4R? So you can grade the distance, A, B, C, or D. You can grade the turn, the base support, the confluence needed to actually send you the other way, A, B, C, or D. And for the A trades, if you have an A for distance, you have an A for turn, then you want to risk more money. Whatever you decide that is, like I said, these numbers are simply for 70% chance, 3,000 target over 2,000. Don't focus on these numbers. Grade your trades and risk more money on A base setups and A range. And then if you have an A base, but you only have a C range, maybe you're looking at a 1-to-1, right? It doesn't have that much range before it hits some resistance. You have to bet less, okay? By using asymmetric betting, it allows you to make way more money on your A plus trades, where you have a good base setup, a good support, a good turn range, and then you have a good range for the trade itself. And you're going to sit back. These trades might come around once a week. They might come around once every 2 weeks. For most of us, you can find A plus setups at least once a week, if not 2 to 3 times a week, okay? Because we're not swing traders. By risking more on your A plus setups, you will dwarf all of your C trades, your B trades, and all these trades that are just nickel and diming you and taking away from your P&L little by little. And by risking less, dramatically less. Look at this. I mean, this is, if I'm doing a 1.5, 45% chance. In this scenario, I need to risk $17. Like, what is that? That can barely buy you a sandwich. That's essentially risking nothing, right? And look at how much it changes as you start going this way. It really brings it home that for the C trades, for the low probability, low range, you need to be risking nothing, essentially. You can honestly maybe even skip those trades. And I know it's hard for a lot of you guys to skip trades, but I want to wrap this video up. So this chart shows you the power of really oversizing, and don't even think about it as oversizing. You're properly sizing with higher risk, the better the opportunity. And what this chart shows you is that by doing that, you are not reducing your overall success, your overall risk. 70% chance of passing, okay? Even risking $961 on a 2.75, 60% trade. A lot of you might think, to really pass this, I need to be conservative, risk $200 across the board. If I wanted to risk $200 on a 2.75R trade, it needs to have a 45% success rate. Anything other than that, and I'm not risking enough. Okay, if I'm looking at a 50% chance and I'm risking $200, I am not being efficient with my capital. I'm increasing my percentage pass, but if I do a flat standard risk, it is hurting me in the long run because all of my C and D trades are dragging down, weighing on my P&L. So I hope this makes sense. Ask me some questions below if you have any questions, but I want to see you guys start using asymmetric risk, even if it's just a little bit. Have risk units, For a C trade or a D trade, risk half of a risk unit to 0.25 of a risk unit. For a standard B trade, risk one risk unit. And then for an A trade, risk 1.5 risk units. And for a A best setup you're going to see all week, put the size down and risk 3 or 4 risk units on that particular trade. And you will see your P&L curve really start to expand towards the upside because you're capitalizing on your best opportunities and you're limiting the downside on your worst opportunities, even if the bad opportunities are winners. And I want you guys to know, if you put down size on an A++ trade and you lose, it is okay. The math will work out in your favor over time to keep you highly profitable. So it's okay to lose 3 or 4R on an A++ setup. It is not okay to risk 1R on a C setup, on a D setup, okay? Flip the script, flip your thinking, and you'll start to see your P&L curve, move up and slope up and be rewarded by the patience and by the good trades you are taking by putting size behind your best opportunities. All right, guys, that's all I got for you today. I'm going to make another video later about some other stuff, but have a good 4th of July if you're in the Northeast like I am. Stay cool. It's over 100 degrees today. All right. Have a good one. Talk to you later.